Jill, I fear that you have some bad news for us because you have a sense that there is still more downside to come.
Thanks for having me. We think so. I mean, earnings we're expecting could slightly miss consensus this earnings season. The downward revisions that we're expecting, we haven't really seen yet when you look out to the next few quarters. So I think, this earnings season could be okay. But when you look out to fourth quarter 2023, we think consensus is still way too high. We think margin expectations, given inflation and the labor pressures that we're seeing, are too high. So, we still think that guidance is going to be one of the most important things that investors are going to be looking at.
This is not an earnings story we should be focused on. This is a guidance story that we should be focused on in the next 2 weeks.
I think so. The guidance that we've been seeing, the pre-announcements, when you look at news stories for negative pre-announcements in August, they hit record levels. Last earnings season, you started seeing more commentary in terms of weak demand. So we think what corporates are saying and the guidance they're going to be giving may matter more than just third quarter results themselves.
What is the chance, though? You have also said that you think markets are much closer to your S&P 500 year-end target, which I believe is 3,600.
That's right. We've been looking for 3,600 for year end. So obviously one of the more cautious strategy teams going into the year, and we've now been very close to that target on the S&P. So even though we could be close to the levels that we're forecasting, could be the year end target, we think it's going to be a bumpy ride from here. We're likely to see continued volatility. We are looking for a mild recession in the first half of next year, but obviously if that's more severe than we're forecasting, we could see lower levels on the S&P. We've been highlighting, 3,000, 3,200 could be sort of a worst case scenario.
That's the worst case scenario. What's the best case scenario?
I think, we're getting to the point where sentiment, many of the measures that we're looking at have been getting more bearish. Flows have been starting to see outflows, but, not yet capitulation, not yet a buy signal on the sentiment indicators that we're looking at. So we do think that you need to see, kind of more of a deterioration in sentiment to really, give that buy signal on the market. The bull market indicators that we look at in terms of things that usually occur before the market bottoms, and not enough of those have occurred yet. Interestingly, the Fed usually cuts before the market bottoms. Maybe the market anticipates that a little earlier this year, but we're not looking for Fed cuts until later next year. So we think it's most likely that we'll see volatility continue from here, but certainly opportunities within the market beyond just buying the S&P 500.
But if you think just to clarify the point, if you think 3,200 is the low on the S&P 500, which would require some form of capitulation, I would imagine. I mean, some kind of dramatic downdraft at some point along the line. What would be the dramatic upside view?
Well, I think some of the sentiment indicators that we're pointing to suggest that the market could see healthy, whether it's high single digit or low double digit gains from here on a 12-month basis. Okay. Valuations, while they're not super predictive of near-term returns, if you look at it on an annualized basis over the long term, starting to suggest more healthy returns than we were looking at when valuations were more expensive going into the year.